Good afternoon. It is July 18th. That is the Monday after options expiration Friday. So we had some options expire on Friday and some puts got assigned to us. So let's take a look at what happened for me. I had 3 puts assigned to me. Ametis, which is now a 4.5% position. New Fortress Energy, which is now a 6.7% position. And Azure Power Global, which is now a 3.2% position. Now, for all those people keep giving me a hard time for not being an energy investor, I think maybe you'll notice a trend here. That is, in those 3 stocks, 15%, whatever that is, and I have a couple of other energy positions as well. So I'm still an energy investor. I just don't buy oil stocks that have little else to offer, especially since EVs hit 5% of total market share in the last quarter. The breakdown in oil is in its early stages. The prices recently have only been supported by disruptions in the market and manipulation by OPEC. And now OPEC, apparently President Biden offered them something that they liked, is going to put a little bit more oil into the market. Saudi Arabia agreed that they could go up to 13 million barrels a day if need be. And really, it seems like, according to the reports from Bloomberg, that they're going to do exactly what I suggested they would do, which is fill the gaps that other OPEC producers are approved for, but not filling. So we have seen the price of gasoline at the pump go from over $5 a gallon in Wisconsin, just barely over $5 a gallon in Wisconsin, down to about $4.30, $4.40 today. So we've seen 15 to 20% drops in the price of gasoline during the peak drive season. That is also being facilitated by the releases of oil from the Strategic Petroleum Reserve, which it looks like Canada and the boys in Texas are going to help refill. So I like energy because I believe that the need for electricity is just going to go up and up and up, and heating and cooling, obviously also big deals, but that it's not the oil companies that are going to be the big winners here. And I actually have an article about energy that I'll show you just a bit of right now that is on its way to being done. Stocks of the week will be about energy stocks, and this actually has the summary in it as well. But there are certain things in the energy market that we want to look at. Over the rest of this decade, clean energy investments will do better than most fossil fuel investments. This is because clean energy investments are beginning from small numbers, have a massive total addressable market, and the divestiture movement on fossil fuel securities, which of course pushes the price of those securities down. Companies that can produce renewable biofuels without impacting the food supply should do very well. Ametis. Already we are seeing GE begin to build and making a huge investment in biofuel jet engines. That probably explains why San Francisco airport is going heavily towards biofuel for their jets. Many trunking fleets are also moving to renewable biofuels and natural gas. Carbon capture, according to Joe Manchin, is going to be an important part of the bridge to a carbon neutral economy because clean energy by itself cannot do it fast enough. And clearly he's getting paid off. So whether you believe that we need carbon capture or not, it's going to be part of the mix. And it's probably going to get government subsidies because if anything else gets government subsidies, carbon capture will too. It is a way to help our fossil fuel companies adjust and to protect a lot of those jobs. As an investor, those are the areas I want to focus on. So they'll include, but probably not limited to, solar, pretty much top to bottom, with the possible exception of panel makers, which I think can become commoditized. So I'm not a big investor in First Solar. They're not even on my list anymore. I liked them better when they were building things, where there was margin that they could take out and ongoing fees from service. Battery storage for alternative energy, including the software that controls it. There's an oligopoly in that market between Enphase and Solar Edge. EV companies with superior fourth industrial revolution manufacturing technology. So not just a good car design, but all the technology to build it and maybe build the cars for other designers. Biofuel refiners that are adding capacity, Ametis. LNG companies with unique competitive advantages, New Fortress Energy. Natural gas and CO2 pipeline companies, Kinder Morgan. Carbon segregation companies, carbon capture and efficient storage capacity companies. So that'll include some of the oil companies and a few oil producers with low cost conventional reserves that require low capex for the long, slow end of the oil age. So what company do we know that a certain gentleman in Omaha is buying up a lot of? It's a company with tremendous conventional reserves and an approach to using CO2 to get it out of the ground that is actually more well known for being a fracker, just because people look at that whole basket in a more homogeneous way. But the reality is that Occidental Petroleum, which I've been telling you for a few weeks, if you wanted to buy it for a relatively secure and safe gain, you could go ahead and buy Occidental Petroleum for any price below Berkshire Hathaway's warrant price, which was like $59.60 or something. I've just been telling you buy it anytime it's under 59. I know that several of you have because you posted it in the chat room. So I have a list of energy companies that I'm building here for you, and I'll put in notes along the way. But this is the general thesis, and I have 2 articles coming out with the same verbiage because it is the backbone of a presentation that I'll be doing at the Money Show next week. So if you want to jump in on these, go ahead and jump in on these. I think they're charging for this one. You don't need to pay for this because I give this to you for free. It's just a 4-step process and then covers the large secular trends. I don't know if this one's free or if you have to pay for the show. You have to figure that out. Virtual pass. I think you would have to get a virtual pass. So $39. It's pretty cheap. I would do this if I were you. For $39, I don't think you can really go wrong. Get a lot of different presentations. You can skip this guy. I think Bob Dahl is probably worthwhile. Louis Navalier is probably worthwhile. Harry Boxer is interesting sometimes. You know, some of these folks know their stuff. David Keller is okay for technical analysis. I don't think you need to buy anything because really I have access to almost all this research and I bring you the best stuff. But I think that watching this for a few days would just give you a more circumspect idea of why I say and do the things that I say and do. You know, I'm borrowing from some of the best in the business, and then I attach my own ideas to it, and it usually ends up working out pretty well in the long term. If you're a trader, of course, you want to be over at Fundamental Trends and in the chat room with Shooter, who has been fairly prolific as of late. Just a lot of stuff that he's had popping up. So one of the things that Shooter put out this week is the wave counts for all of the plug and play stocks. This is up at Fundamental Trends right now, and will get copied over to Seeking Alpha as soon as this webinar is over with. And the retirement income options article is up at both sites right now. So which calls expired? That would be the Planet calls we wrote a couple of months ago, and the Warner Brother Discovery calls we wrote a couple of months ago. So that was a buck and change that we got for the Planet calls, and I think it was $3.55. I don't know. They were both right around 10%. So we made about 10% on both of these covered calls for 2.5 to 3.5 months of holding them. Right, that's a great return, especially if you do intend to hold these long term. If you look at these positions over quarters or even a year, you know, you're gonna go, oh, I'm down. But over 2, 3, 4, 5 years, when you've piled up option premium, and then you finally get the rally that you've been looking for, and then you right size your position at that time, you go, oh, wow, look at all the extra money I made because I already took some partial payments in the form of option premiums. So my option premium this year is well over 10%. That has defrayed the losses by quite a bit, along with the large cash position, which I have started to utilize and have been urging you to start to utilize. So I think that there's some puts that you can sell today. You can take a look at all the 3 June articles, and the 3 June articles all those options are still good ones to sell, especially the satellite as a service stocks and a number of others. Just push it out one more month on the expiration. So the two that I'm looking at right now for today, because as you know, when we screen, right, we're taking a look at what is oversold and overbought right now. So right now, there's almost nothing overbought, but there is quite a bit that is oversold. So Planet, Spire, Black Sky, Satellogic, right in a row. 1, 2, 3, 4, boom, 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 boom. All super oversold. And that is part of the all things SPACs, I hates it movement among retail investors. And what's interesting to me is that the retail investors come up with their narratives about why things are bad investments. Meanwhile, the wealthy and the private equity investors are buying these things. Family offices are buying, a lot of small caps, and Bitcoin. So when the super wealthy are buying, and I know this is beating the drum for about the 1,000th time in the last couple of years, but when the super wealthy are buying and the wannabes, right? We're all wannabes. We want to be wealthy. Some of us are closer than others. You know, to me, wealthy is 8 figures. Well off is 7 figures. So I'm well off. You ask yourself the same question that you should always ask yourself. If the wealthy are buyers and the not wealthy are sellers, who's probably right? So I would suggest that Planet, Spire, Black Sky, and Satellogic, you should all own at least a little bit, because the upside of the satellite as a service industry is massive. Think about what software as a service was or is, and this is going to be a big segment within that larger segment. Coinbase, I already told you, not so sure about. Ginkgo Bioworks, I really love. Heron Therapeutics seems like it should be gigantic. COVID messed them up in the short term, and I think that that is an opportunity. PayPal, I still think is going to be a big deal, and I think it might get acquired by a big bank. Netflix has their earnings tomorrow, and we have a starter position in Netflix that's already up about $20 a share. I debate just selling it out today because I don't have great hopes for Netflix tomorrow, but I like my starter position, and I'm not really in this for the short-term trades. And I already took part of the position off to take some profits. So my cost after profit at this point is probably around $170 a share. And I can't see Netflix going much lower than that. Netflix is about to launch a ad service. That means that they'll get something out of all those people who piggyback, because they're going to change the policy, not allow so much piggybacking. They can control that. And people who are piggybacking will just get a notice, hey, would you like to get a membership of your own that's ad supported for like $4.99 a month, or for $14.99 a month, you can have everything ad free. It's going to work something like that. And that means that the half, it's really about half of people who watch Netflix but don't pay for it are going to end up paying something, and there'll be advertiser revenue. So I like Netflix for those reasons, and I can't see some sort of M&A not coming to pass, whether they get bought, whether they do some sort of a new joint venture with NBC Universal. I don't know. But they are talking to NBC Universal and Google, so Comcast and Google, about sharing their technology, which apparently is a level ahead of everybody else. And remember back when I was talking about the HBO Max interface and then compared to the Netflix interface, you can kind of see that Warner Brothers Discovery is already catching up, but not everybody else is. So when I talk about over-the-wire competition to Roku and various over-the-wire competition for the streamers in general that Comcast and AT&T and some of the others could provide, it really is just a question of getting the technology up to speed. So we already know that you have Channel Guide on the wire. There's no reason why they can't build in everything else and bypass the hardware. And that's something that I learned the other day. I just bought another Roku TV from TCL. It'll probably be the last one I ever buy, because Roku really doesn't have a TV contract anymore, which makes me wonder what is going to happen to Roku. It has to go through some sort of M&A at this point. I just can't see it not. That makes a lot of sense to me for Roku to end up in a deal with either Netflix, as has been rumored, or Comcast, or even AT&T maybe. So we'll see. I go over these things because I think it's important to get a little update. And frankly, there's just not a lot of options to talk about right now. So I ended with those media companies, and the Warner Brothers Discovery put right here, the $35 put for $250 or more. Oh, excuse me, that's Caesars. The Warner Brothers Discovery put for $12.50 for $1 or more is probably one that you can sell. So if you don't own Warner Brothers Discovery, and I know probably some of you don't because you're newer, take a starter in a Warner Brothers Discovery and then sell a put down at $12.50 with $1 premium, so you get it netted out at $11.50. The chart on this is pretty attractive from a valuation standpoint. This was a spike, so normally you take these Fibonacci lines and you go all the way to the top. I'm considering this an anomaly. I'm only going up to this point right here, which ended up being kind of a spot twice where you got some unusual price activity. From here, which I could have used that line too, all the way up was that hedge fund that bid it up and really bid against itself. So it was a really unique situation. This ends up being about right. So just imagine that the price never went above this level. We are way below not only fair value on Warner Brothers Discovery, but it is grotesquely sold off and is starting to chop along. So this is probably an absolute bottom on Warner Brothers Discovery. I mean, they make hundreds of millions of dollars, and they have global penetration because of Discovery. I honestly think that if you're a growth investor and you want something that you know you're going to get a ton of revenue out of, and you know with Netflix launching an ad-supported service, which means that they have to pay extra to Warner Brothers Discovery and Paramount and NBC Universal and Sony for the content. That's what some of the articles are discussing on Wall Street Journal right now, is all of a sudden all these studios that sell content to Netflix are going to get a premium above what they were already making. And I think ultimately somebody says, just let's merge. I really do think that's coming for Netflix, unless the management just doesn't want to merge. But I don't know why they wouldn't merge with. Honestly, I think the perfect marriage is NBC Universal for Netflix. But you have personalities involved, so we'll see what happens. If I can't get you to buy Warner Brothers Discovery right now, I don't know what else it would take. The company's making money. The company's expanding. They're about to get extra money from the big player in the industry, which is Netflix. And the price has been jitterbugging for a month, actually 6 weeks now. So we take a look at this, right? It's not diving anymore. Going sideways for quite a while. So jump into this, sell that put. If you already own the stock, just sell the put. Unless you have a huge position like me. My position on Warner Brothers is 5.6%. I really can't sell more puts. I'm pretty much maxed out on this one. I would love to, but you have to mind your asset allocation. The new put I'm selling is on Caesars, and I talked about Caesars last month when I was in Vegas for the World Series of Poker. And I told you it might be bottoming out. And I also told you that I've never seen Vegas so busy, and I've been going since the 1990s. It really was one of the busiest places in the world, probably over the last several months. It's easy for a lot of people to get to. They don't really enforce any type of health protocol anymore, which is why I think almost everybody on my plane back had COVID. In hindsight, I should have just kept my room for another week, and I should have just played online poker while I was sick, and then when I was healthy, gone back out. But, just in case I would have gotten really sick, I wanted to be at home. But I think Caesars, which has several big properties, including the Flamingo and the Tropicana, that if they want to sell them, they're going to get around $1 billion for either one of those to reduce their debt load. And if you've taken a look at the map of Caesars properties around the United States, that's a pretty impressive list. So between Vegas and their international holdings and their holdings around the United States, and the fact that they use all of those physical locations to promote their online gambling, I think Caesars has a more asset-light model developing with very good synergies on the advertising and the linking of their different services to sell their other services to promote, co-promote. I know that they're redoing their credit card right now because I was going to apply for their credit card, but it's not available right now. They're switching banks, it looks like. And Caesars at this point is, I think, about as cheap as you're going to see it, right? This area right in here, unless there's a big recession. If there's a big recession, it'll come back down in here. I don't really foresee a big recession. If there's a recession, it'll be short and shallow, in my opinion. Because as I've said over and over again, I think the Fed is going to back off sometime in autumn. So I think if you want to start getting into Caesars, I'm not taking the starter here just yet, just in case we do get that recession price. But I am selling this put, the $35 September put for about $250, and actually it hit just a couple minutes ago. So I sold it for $250. I was trying to get $260 and I couldn't get it. Maybe later in the day you can, but I wasn't going to quibble over a nickel or a dime. I'm pretty sure that this business is healthy and it's going to get more healthy. Remember, the casinos in Vegas paid their rent during COVID 100%. There wasn't even the bad casinos or the lower volume casinos. There wasn't a single casino that didn't pay their rent during COVID, to my knowledge. That's how good these businesses are. And if you really want to think about the casino industry in Vegas and how good they are and how smart they are, their management is way ahead of everybody else. They developed so much solar energy that they're essentially on their own microgrid. They have a giant solar facility in the desert. And to get that approved, they built enough capacity to throw off extra energy. My parents got a free month of energy living in Las Vegas. They did. That solar development that they did for the businesses threw off so much extra energy that it was either last year or 2 years ago. I think it was 2 years ago. Everybody got the month of July for free. In Vegas, in the summer, when everybody's running their air conditioning. Think that through. That's how far ahead in the game these guys are on energy. And they've done it with water too. Las Vegas is one of the most sustainable cities in America, which is weird to think of it that way. But they're way ahead in the game on alternative energy, and they're way ahead in the game on water because they've been accumulating their water rights for a very long time. And ultimately, at some point, Arizona and California are going to start solving their own problems on water because eventually Las Vegas is going to say, hey, all those water credits we have, you can buy them from us or maybe build desalination plants. At what point does Las Vegas hire a lawyer, go knock on somebody's door, hey, you want a case, and say, look, we want to start enforcing the water rights. We need to push California into a deal. And by the way, Arizona too. So one way or another, Las Vegas is in the catbird position here because they're the ones who have saved their water rights for 20 years. They have more rights to all that water that comes out of the rivers in the region than Arizona or California. So there's going to be a deal pressed at some point. And Vegas is going to come out very well for it. Google Las Vegas and sustainability. They've been doing all the right things. And these casinos are leading the way. One of the things that you could ask, and another one of my follow the money stories is, the casinos in Vegas are still selling for a lot. And you just saw 2 giant casinos get built. Why would billionaires be building these things if they didn't think they were going to get a long-term return on their money? Have you been to Resort World? It's beautiful now that they're done. And they built the ceilings really high. And I don't know if that was a remodel because of COVID or if they were already going to do it. But they built the ceilings really high with amazing air filtration. How's that for a place? Everything that the realities of COVID has introduced, they solved for. Either by just being forward-looking or they adjusted on the fly. I'm not sure which it was. Building a basketball arena, rumors of Major League Baseball. They already got the Raiders, the hockey team they already got. These casino companies are incredibly well-run. And that's one of the things that we always ask for, well-run companies. I don't know that there's companies run much better than these casino companies. And yet, they get beat up during recessions, which doesn't really make a lot of sense because they're relatively recession-proof companies because gamblers gamble, right? It's a habit. It's an addiction for a lot of people. And it's just a great vacation. All right. A lot of people like to go to Vegas. It's a great getaway. So I really would like to see you to get involved with Caesars. They're going to be on the plug and play now. They've been on and off. I told you that they were probably coming. Any questions? Here's the put for Warner Brothers Discovery right here. Here's the put for Caesars right there. Because I know people get antsy about having something assigned to them. I want these positions in these power companies. Somebody asked me to compare Caesars to Vici. They're different types of companies, completely different companies. Vici is a REIT. Caesars is a casino. Not even comparable anymore. Completely different types of companies, completely different. But these energy companies is what you should also think about. What's going to happen this winter as Russia's oil supplies keep getting cut off and Russia maybe makes some threats? And that's really the one thing that could throw us into a big recession, is if Russia just decides to play God with the world for a year or two on energy. But that is why one of the things that I'm talking about, the OPEC and Russia just accelerated the clean energy transition. That's what they did, which is why all these companies have something to do with the clean energy transition. Ametis is biofuels, carbon neutral biofuels, actually carbon negative. New Fortress Energy is natural gas and hydrogen. Azure Power is solar utility in India. So, all right, let's call it a day. It is 12:45, and I'm going to get these energy articles out by tomorrow. I'm going to take care of my grandmother for part of today. She is in the process of moving to assisted living. So I have to give a break to my parents and my aunt today. All right, everybody, have a good rest of the week. I don't think that this correction is over with. I think that we're just getting a little bit of upside activity on the options expiration. And I think that until the Fed hints that they're going to back off, we probably have more downside. And I don't think the Fed is going to talk about backing off until September or October, one or the other, probably September, because I think that the inflation numbers are all starting to turn over the way that I said that they would. Well, they'll want confirmation, just like Joe Manchin wants confirmation, but it's coming. And I think what you're going to see is not interest rate reductions anytime soon. I just think you're going to see them stop tightening. And that will create a bit of an equilibrium, because I think we're very close to the neutral interest rate right now. I don't think it really is any higher. I think we're about at it. And I think that with the economy doing as well as it is, we're going to have a very weird equilibrium period. Usually we pass through equilibrium. I think we're going to hold it for a year or two, maybe 3. And we're just going to get a gradual lift in the market, lift in the economy, stay near full employment without being overheated. This is just an incredibly strong economy, folks. And it should spread out to more and more people over time. If we ever fix the tax code, if we ever actually have a minimum corporate income tax, man, I'll just tell you, the United States really could pay down our debt gradually over 30 years, the way that Joe Manchin actually has talked about. I think it's going to happen without a lot of effort, actually. I think over the next 15, 20, 30 years, the economy is going to be that good. There's just very little negative outside of the actions of rogue actors. There's just very little bad in the economy. You have the emerging markets growing. You have the United States just in a tremendously powerful spot. I got India. I can't see the negatives that a lot of people are talking about. And remember, what did everybody call me in 2019 and 20 and 21? They all called me a perma bear. So when the perma bear says, this didn't get as bad as I thought it could get, and it's starting to get better, and the fact that a war, this is all that it did, is cause oil prices to go up to 120, and you guys just start thinking things are pretty good. And if we keep rebuilding the world the way that I've said that we need to do, which will take 2 generations or 3 generations, right? So a lot of long-term jobs. And this technology is so amazing on the robotics side with the AI and the machine learning, and the augmented reality that now technicians can do things twice as efficient or 3 times as efficient. And if we get smart about immigration in this country and we let in the 10 million people that we need to let in, right? You start letting in families. Dad works and the kids grow up here in our schools. I'll tell you what, these people who are running around shooting other people, they got it all wrong. They're reading too much bullshit on the internet. We are looking at a really good long-term run here. And yeah, there'll be potholes. Use those to buy. Things have always gone up and to the right. It's going to keep on happening. These big corrections are buying opportunities. buy the big secular trends, because not only will you get the normal expected return, but you'll get something extra. And because the trend is on your side on the economics, your risk is lower. All right. Have a great day.